Welcome to part 4 of our 10-part series on calculating the economic and environmental cost of Bitcoin. I'm your host Hass, and today we're talking economics again, and we'll specifically look at perfect competition and the Bitcoin microeconomy. The example of a hypothetical firm in a perfectly competitive market is taught in most introductory economics classes. There are effectively 9 conditions that define a perfectly competitive market. Homogeneous products, guaranteed property rights, non-increasing returns to scale, zero or near zero transaction costs, perfect factor mobility, no barriers to entry or exit, many buyers and sellers, perfect information, and no externalities. When compared with real-world data, the Bitcoin mining market doesn't meet all aforementioned conditions of perfect competition due to a relatively low number of ecosystem participants, currently resulting in wealth and information asymmetry. However, the Bitcoin mining market is trending towards becoming perfectly competitive as the wider Bitcoin macroeconomy grows, which we'll now demonstrate. As at the date of this video, the Bitcoin mining market satisfies 6 criteria of a perfectly competitive market. Bitcoin's nature as an open source, encrypted, distributed ledger means that the blockchain guarantees property rights and homogeneity at zero or near zero transaction and storage cost. The factors of production, that is labor, equipment, capital, are mobile to the extent that only a communication link and a power source is required to participate in the ecosystem. Due to its economic incentive mechanisms, any mining entity approaching 50% of the network hash rate would experience non-increasing returns to scale, if not jeopardize its own existence, as witnessed during the gigahash.io saga of 2014. Developing on top of Bitcoin requires no permission, and if entrepreneurs have a good enough idea, securing startup capital is not a difficult barrier to entry to overcome, with over $1 billion invested in Bitcoin startups to date. Low barriers are also commonplace in very young markets, with copycat companies popping up en masse. Conversely, barriers to exit are quite low for most market participants, except for heavily leveraged or undiversified miners who risk holding highly specialized computing equipment that may be unable to mine other digital commodities. This is no different to traditional undiversified commodity miners. The satisfaction of the final 3 conditions relies solely on the growth of the network and the passing of time, and we'll spend a little time discussing each one of these things. The current size of Bitcoin's user base is speculative, and always will be, due to its pseudonymous nature. CNBC reported that 8% of American adults had invested in cryptocurrency. Yahoo Finance reported that 16.3 million Americans buy and sell Bitcoin frequently. Coinbase reports that they have over 20 million users. Meanwhile, in some parts of Europe, it's estimated that an average of 4% of consumers use cryptocurrency as a payment method every day as of 2016, with Eastern Europe leading the charge at 11%. When adding US and European numbers and noting that data for Asia, Africa, Latin America, and Oceania are omitted, a high estimate of over 50 million users can be made. Although this sounds like a market with many buyers and sellers, 50 million people only accounts for about 0.8% of the world's adult population. A much lower estimate of between 2.9 and 5.8 million has been highlighted in a very detailed assessment of the global cryptocurrency market produced by Cambridge University in April 2017. But note that things have changed quite dramatically since April 2017, when price was only about $1,000 right before the big hype of late 2017, where a significant number of new users would have come into the ecosystem. From a commercial markets point of view, a strong case can be made that only a few participants have an inordinate, albeit temporary, grip over pricing and information. The temporary nature is shown by looking at the evolution of the distribution of coins by wallet balance. We can see that there has been a flattening of the distribution of coin holdings away from large wallet balances to much lower balances over the past 4 years, with the orange line representing 2018 and the blue line representing 2014. We can see that coins held in wallets with balances containing between 0.001 to 10 bitcoins have grown dramatically. This movement is backed up by a study of Bitcoin unspent transaction outputs by Unchained Capital, studying the shift of old coins into new hands over time. They noted that 15% of Bitcoin moved out of wallets that had been dormant for 2 to 5 years during the 2017 rally. This trend of a flattening in distribution is expected to continue as spent Bitcoin is spent forever and needs to be earned back. It should be noted that all wallets with a balance of over 100,000 coins are verifiably held by identified exchanges or custodial wallets. This is unlikely to change for a while and skews the graph quite a bit. Bitcoin's current major externality is the carbon dioxide emitted by hardware operating and securing the network, which is discussed in great depth at the back end of this series. Therefore, as the world moves towards carbon-free energy sources over the coming centuries, in addition to cleaner and more efficient mineral mining and e-waste recycling technology, Bitcoin's carbon dioxide emission externalities will eventually tend towards zero. To sum up, Bitcoin is not perfectly competitive in its current state, but is very close to becoming so. The first 6 of the above conditions are met in the short term, with the last 3 destined to be met, if not already partially met, should Bitcoin have a long term. Most importantly, in a perfectly competitive environment, marginal cost to produce a good is equal to the marginal revenue earned from selling that good. That is, in long-term equilibrium, cost to mine will be equal to the price of a Bitcoin, and in the short term, this equilibrium point will be established by the market. Next week will be the final part of the series on economics, but we start getting into the good stuff after that. We'll be talking about perfect competition and Bitcoin managerial economics, and we hope that you'll join us again then too. As always, thanks for watching. Click like and subscribe to our channel, leave a comment below, check out the links in the description for more info and references, and catch us on Twitter and LinkedIn for more. Until next time.